Let's talk about inflation and real estate in the context of inflation. Now, real estate investments have always been on the list, fairly far on the top of that list of investments that you should go for in times of high inflation as a protection, as a hedge against inflation. So the idea is when your money loses value, your property will not lose value. So the prices will go up along with inflation. Now that may or may not be true. Either way, here in Bali, in many countries in Southeast Asia, as a foreigner, we're often looking at leasehold investments, and that means you don't have the eternal investment, the eternal value, long-term value of that land, of that property. So that brings in a slightly different dimension. So let's look at inflation for now. And let's start with money. And what is money? I let the Grandmaster himself explain that. I could not do it any better.
Uh-huh! Oh, $20. I wanted a peanut. $20 can buy many peanuts. Explain how. Money can be exchanged for goods and services. Woohoo!
So as he said, money, you can exchange it for goods and services. I couldn't have said it any better than him. And there's a second very important function of money, and that is store of value. So the idea is you can use your money today to buy, I don't know, some eggs or whatever, or you can do that tomorrow or in 10 years. So store of value. Now you can buy a dozen eggs today or in 10 years. The price might be different. Some things go up in price, and that's what we mean when we say inflation. But some things also go down in price. Think of a flat screen TV, for example. Great example. The prices for these have always been going down. These days you can get a nice TV for less than $1,000, I guess. And the same TV in 10 years you get for $150. It's absolutely crazy. So some things go up, some things go down in price. And in average, and that's like also a science how to make that average, because what you consume is of course very different. Prices go up slightly over my lifetime, and of course it depends on the currency, on the place, the country where you live. Over my lifetime the inflation was always very, very low, so like 2%, which is mostly by central banks considered to be ideal. So I had that. At times I had even a negative inflation, which is very, very strange. That means your employer can give you no pay rise and claim you got the pay rise by getting the same salary for the next year again. And in the last 1.5 to 2 years we have seen a very high inflation. Officially it's 5, 6, 7%. Depending on what you buy, it can be much higher, it feels much higher. So suddenly inflation is a big topic for everyone, and we need to understand what does it mean, how do you deal with that. Your salary often did not catch up, mine didn't. So how do we deal with that also with our savings? What's the impact on our savings, on our investments of a high inflation? So prices have gone up. What does it mean to our business? And I see an investment in a vacation rental not so much just as a investment in a building, but in a business. That means you put down money on the table on day one and exchange it to a series of cash flows on an annual basis for the coming years. So the profit it will generate over the next 10, 20, 30 years. So how do these profits evolve? Now the thing about building or constructing a building is prepaid expenses. I think that's really the key word here. When you rent, you pay on a monthly basis for the property you live in, When you buy, then you pay once and you can live there more or less forever, as long as you want. Now, when we think of the expenses that come into play on a vacation rental, of course you have, let's say the guest comes, you have to pay for the electricity, for the cleaning, for the laundry of the towels, the bed sheets, all that. These are expenses you are not prepaying. Then there are other expenses, clearly prepaid. The land, 100% prepaid. And then there's stuff in the middle. The construction of the building is to a high degree prepaid, but also not 100%. Think of the maintenance, think of the insurance. The insurance price depends not on what you paid to build the building, but how much would it cost to replace it, to reconstruct it, if it gets destroyed by fire or by an earthquake. So the insurance will go up, taxes might go up, maintenance cost will go up. These are more driven by the labor market, by the parts that you might need to buy to fix stuff. So a small degree of the construction is not secured, not prepaid, secured against inflation, but a big chunk of that is it. And that means the degree of prepaying expenses on your investment is different. If you have a, let's say, a tent with a lot of services, so you have cheap construction, a tent in the desert, cheap construction on cheap land, but a lot of services like a chef, food, providing food, all that, then you have a very low degree of prepaid expenses. If you have a building in Manhattan, high price land, expensive building, very little services attached to that, then you will have a very high degree of prepaid expenses. So these are the differences. And if you want to really plan for high inflation, you should keep an eye on that. What extent of services, what extent of prepaying expenses are you going for? So that's really inflation in construction, in short-term rental business, and prepaying these expenses in a high inflation world can make a huge difference. So perfect example of what you can use to visualize that is you have electricity hookup to the city electricity, or you put solar panels on your roof. So either you pay on a monthly basis for your electricity, or you pay once and get your electricity for the next 20 years already paid for. It's really inflation hedging if you go for that. So consider these factors when you're constructing, when you're designing your property, but also consider it when you look at your overall portfolio. What is the impact of inflation in the country? What are the drivers of inflation in the country you are investing in? And after all, it's the drivers, what is impacting the inflation is not just the economy and like short-term interest rates and all that. It's also demographics. So there are some long-term factors that you can use to anticipate how will inflation behave in a certain area, in a certain country in the long run over the next couple decades. Because after all, that's the time horizon we are talking about.